Good morning, friends, and thank you so much for joining into another episode of your favorite program, The Money Minutes. Today we have a very special guest. He's a lawyer, pension lawyer. His name is JP LaPorte, and we're going to be interviewing him and asking all the questions that you have had on your mind in regards to having a personal pension plan. JP LaPorte is a pension lawyer by training, specializing in employee benefits and retirement plans. He has written a number of journal articles on pension reform and pension administration. He has often appeared as an expert witness before standing committees of the House of Commons and was awarded the Queen Elizabeth II Diamond Jubilee Medal in 2012 for all his efforts at improving pension security for Canadians. What a great achievement. Until July 2012, he practiced out of Toronto office of Bennett Jones LLP, a leading Canadian business law firm. He was then appointed Chief Executive Officer of Integris Pension Management Corporation. So without further ado, let's meet Mr. JP LaPorte, a pension lawyer. So let's get started. JP, I am very familiar with the individual pension plans, but not so much with personal pension plans, PPPs. So my question to you is, first question, what's the difference?
Wow, seeing lots and lots of differences between an IPP and a PPP. The PPP is what we call a combination registered pension plan. So it combines everything an IPP offers, and we call that the defined benefit component, with a defined contribution account, and a third account called the additional voluntary contribution account. So when you're talking about a PPP, you're talking about three separate components all working harmoniously under one single roof. And as a result of having this triple account structure, our customers are able to put more money, significantly more money aside in a registered environment, so free from taxes, over longer periods of time than an IPP customer, which means that for the exact same level of risk, for the exact same income, for the same age, our customers end up with significantly more money in retirement than an IPP customer.
It is basically a modified defined benefit pension plan that individual business owners, health professional, incorporated business, businesses can use. Give me 5 reasons why a business owner or a incorporated health medical corporation should have a pension plan in place. At least 5 reasons. I know you have many.
Yeah, we have 20, but I'll just focus on 5.
Top 5.
The top 5. First of all, it's all about reducing your tax burden. The more you contribute, the more you claim tax deductions and the more tax you save. So if we can exceed what's possible with an RRSP and dramatically increase the tax deductible contributions, your clients, your professionals are all paying less tax. So to me, that's a good thing.
Absolutely. Anything I can deduct from my taxable income and save it for my future, the higher limit, the better it is for me. Absolutely, I understand that.
So the second one is, because you've got more money contributed to the account and because the account is exempt from tax, it's going to grow over time faster than if you had a non-registered account. So what you're also doing is you're also maximizing your savings.
But isn't that the same thing with RRSP? Because I get to deduct the RRSP contribution from my income, and the growth in that account is also fully tax sheltered until I withdraw.
It's exactly the same principle as the RRSP, except we can triple the amount of money you can grow in a PPP versus what you can do in an RRSP.
Is it because of the higher limits?
Yes, and because there are multiple additional limits or contribution opportunities that exist that don't exist with the RSP.
I see.
That's why.
So you're saying that that the limit for pension plan, personal pension plan is higher than 18% in most cases?
It's usually triple what an RSP can do over a lifetime. So
Wow.
if you were to count, and I've done this, if you were to add up all of the maximum RSP contributions since 1990, every year, and you sum them up, you'd be about $580,000. That's the total tax assistance that the federal government is willing to give a Canadian taxpayer at the maximum, okay, since 1990. With the PPP, that limit is 3 times higher.
Wow.
Yeah, so the principle is the same. You have tax-free, tax-deferred money growing in an RSP. Well, we're doing the same thing, except we're tripling the amount of money that's working in your favor. That's why I'm saying you get to maximize your retirement savings, because you're putting a lot more money to work in a tax-sheltered environment. And at the same time, by the same token, you're collecting all these tax savings because you're deducting more.
Right. So number one, you have higher limits for deduction from your income. Number two, because of the higher limits, your savings are 3 times. So those are 2 very good reasons why we should start up a plan for incorporated business, or even a medical professional who is incorporated.
Yeah. The next one is creditor protection. This is a pension plan. So the money is creditor protected, which if you get sued as a professional and your insurance coverage won't cover that, then at least the monies you've set aside for your retirement are off limits for creditors.
And that's huge, right? Because any business, one of the biggest worries that I hear from my clients is, I don't want to be sued. I want to make sure everything is done properly, but you never know, right?
Well, with us, even if they get sued, the people suing them can't get a penny off of their pension plan.
That's right. That's right.
The fourth key reason is what I call smarter investments. So if you're using an RRSP, you're limited to what are called the qualifying investment rules as to what the RSP can be deployed into in terms of asset classes. And there's lots of things you can do with an RSP, but there's a lot more out there that is not eligible. With the PPP, we're not an RSP. We don't follow the qualifying investment rules. We follow the federal investment rules for pension plans. And those rules are a lot more permissive as to what you're allowed to invest in.
So you're free to, I can choose my own investments, for example. What if I wanted to just invest in properties or commodities or, alternative investments like that? There is no restriction, you're saying, JP?
That's exactly it. So let me give you an example. Let's say you're a farmer and you operate a farm in Southern Ontario. And it's a commercial activity, right? With a corporation, the farm, etc. Maybe your kids are working in the business as well. They're on the payroll. And then there's a big tract of land, farmland, that just opens up across the road or 5 kilometers from the farm. The PPP could use the cash to go buy that raw farmland as an investment. And if you sell that land to a developer, let's say someone wants to build a subdivision, and you paid, I don't know, $1 million for the land, and now it's worth $3 million, the capital gain, the $2 million that you made, is not taxed to you because the pension plan is tax exempt.
Absolutely. And that's a huge advantage.
You cannot do that with an RSP. It's not eligible. You could do it with non-registered money, but when you sell the property at $3 million and there's a $2 million gain, you're going to have to give a big chunk to the CRA.
That's right.
So we're saying don't give to CRA, put in your pension plan. That's
right. So those are good reasons. Is there any other reason you want to share with us?
One last one. And I mentioned the farmer that has his kids or her kids on the payroll. The fifth reason that I want to cover with you this morning is the concept of, intergenerational wealth transfers.
Yes, a big one. And I really want to know more about that because, as you know, I work with with health professionals. And, I've been running this series now saying, whatever it is that we leave in our corporation, what are some of the things we can do with that money that's trapped in the corporation?
Exactly. So some of that surplus that's left in the corporation, you can now put in the pension plan as a pension contribution. But here's how the intergenerational wealth transfer advantage works for our customers. And this is unique to pensions. You cannot do that anywhere else in Canada. So let's say you have the farmer and the farmer's spouse. They're both on the payroll. They're in their 60s. And you've got the children that are in their 20s, 30s, 40s, and they're on the payroll as well, because they're going to be the next generation. It's a family farm. It's been passed down through the generations. So you would set up a family personal pension plan for this family with four, in this case, four participants in it. And what happens is this. There would be a communal account. Remember I was talking to you about the defined benefit component of the plan?
That's right.
Explaining the PPP. So this communal account would have four members participating in it, mom and dad and the two kids. So mom and dad might have a couple $1 million of assets in there, and kids just got started, so they only have maybe $100,000 each.
Right, and that's a normal case. And JP, let me clarify that. I know you're using an example of a farmer, but it could be a medical professional.
Of course, doesn't matter. And the children don't have to be doctors.
Okay.
All they need to be on the payroll.
Okay.
On the payroll. Maybe part-time, maybe clerical minimum wage. It doesn't matter. As long as they're on the payroll for services rendered to the medical professional corporation or the legal professional corporation or dental professional corporation, doesn't matter. So long as they're rendering some services and that it's okay to deduct their salary from the corporate taxes of the company, they can be part of the plan.
Okay, and since you're a pension lawyer, I'm taking this as a liberty to ask you more questions. So this does not interfere with any of the TOSI rules that were introduced 2 years ago by CRA?
No, I mean, you have to be like, the salary that's paid has to be a legitimate salary.
Oh, of course.
So it would qualify under TOSI.
Yes.
Right? As long as it qualifies under TOSI, it qualifies for the pension plan.
That's right. So income split, basically that rule was if somebody is not working in the business, you can't split income with them. But the way I know my clients, almost 90% of them have their spouses or a family member actually managing the whole business.
Exactly. So they're perfect. They're perfect for a PPP. And now I get to the cherry on top of the cake. So mom and dad start drawing their pension and pass away. Had this been an RRSP or a RIF, mom and dad are passed away, there would have been a deemed disposition.
Absolutely, right away.
Right away, the estate would have to pay tax on about half of the money would go to the CRA immediately. The kids would get the other half as beneficiaries. But because this is not an RRSP, it's not a RIF, it's a PPP, the millions of dollars that mom and dad left behind are now recharacterized and are considered pension surplus. It's surplus because there's no one to pay a pension to, they're dead. But the kids are also members of the plan. So now that surplus becomes theirs. And so long as it,
so I have another question, JP, sorry, but so mom and dad passed away. Let's say they both had $2 million in their pension plan. Kids joined, but then after joining, they left the plan and they started their own careers. Then what happens?
Not an issue. Not an issue so long as when the children that are leaving the family business take off, leave, terminate employment, so long as they check off the box that says, I'd like to have a deferred pension. Please pay me my pension entitlement when I turn 65 and keep my money inside the plan with my parents.
And that's all they have to do.
That's all they need to do.
And that pension money does not have to be looked at as deemed disposed of upon parents' death.
No, because it's not an RRSP, it's not a RIF. Therefore, none of it gets taxed. All the value stays in the plan, continues to grow tax sheltered, And of course, the children can now use that surplus to fund their own pension.
Wow.
So they'll never have to spend another penny towards retirement because the parents left their money behind and never got taxed.
Yeah, and I think the $2 million, if you leave it invested for 40 years, that's going to be much more than 14, 15 million, which is more than enough for them to have a very fulfilled retirement.
Yeah. Now, you can also strip some of that surplus out. The children that are surviving, if they want to, if they have spending needs, because it's surplus, it's not required to pay their pension. They can always pull some of it out. That will be taxable in their hands. But, you know, it's still better than giving half of it to the government and never seeing it again.
But it's taxable in their hands. So depending on what their career is like, what they're doing in their life, what their taxable income is, so the taxes is dependent on that.
That's right. And then you can also split it amongst a whole bunch of beneficiaries. So you can do some income splitting. You can also designate a charitable entity like a hospital, a university, a registered charity as a beneficiary. So when you pay that surplus to that entity, because that entity is tax exempt,
right,
then it never gets taxed.
Okay, so let me stay there for a moment. So you're saying the parents donate this money to the, because a lot of my clients are very passionate. They're health professionals, but they're also very passionate, working very, very closely with their hospitals, with their health charities in their communities, and they would love to leave something from their inheritance to a charity. So talk to me more about that. Is it the kids or the parents leaving?
No. The kids enjoy the surplus. If they want to pull it out, it's taxable in their hands, right? But if the kids die and there's still money in the pension plan, it doesn't come to Integris. It stays with the family or any beneficiaries that the members have selected. So if a hospital is listed as a beneficiary of the PPP assets, that's where the money eventually will end up.
Okay, so one more question, JP. I'm sorry, I'm full of questions today. So let's say I don't have family members. I have only husband and wife. Sorry, no children, husband and wife. You know, husband is a doctor, wife is supporting the business, and they both pass away and they have $2 million in their pension plan. Now they're leaving that pension plan to who?
Well, they could list a registered charity as a beneficiary if they wanted to. That's one option.
Okay.
It could be a family member, it could be a friend, it could be whoever they want. Doesn't really matter. But I'm saying that registered charities and other tax exempt entities like a hospital can be beneficiaries of pension plan assets. And when money leaves a pension plan and lands in the hands of a beneficiary, the beneficiary has to recognize the income. If, because of the nature of the recipient, they're not taxable, then that pre-tax money that went into the plan continues to be pre-tax when it ends up in the bank account of the charity.
All right. So, and charity issues a receipt to who? To the corporation, to the beneficiary?
There are no receipts.
So there are no donation receipts back.
It's not a donation.
All right.
It's not a donation.
You know what? That's a good thing, because you're basically saying, here is part of what I've saved that I don't need, and I'm going to help my community with this money.
Yeah, especially, you know, like you were saying, a doctor who spent a career in a hospital and really is thankful for giving him or her a chance to, you know, have a fulfilling career and sees good work being there. And if there's no kids that could benefit from that pension money, why not give back to the community?
Well, what if the kids could benefit and I want to do maybe 50% to the charity and 50% to the kids?
That's what you put on your designation form. You say 50% to my kids, 50% to the charity.
Okay. So JP, all those points are valid and very beneficial. So would you say that PPPs are very popular? Because in my mind, I think not enough people are taking advantage of it. What's the reason? What's the downside of it?
Well, the one Achilles heel of the PPP is that because it's highly regulated, because it's a pension plan, not a TFSA or an RSP. There's more paperwork that comes with it when you set it up and to administer it on an ongoing basis. And because they're more sophisticated, it's harder for salespeople to sell them. So there isn't a lot of money behind selling PPPs because it's much easier for a financial institution to sell an RSP. You can close the deal in 15 seconds and get the money and start making money. With the pension plan, you got to explain all the stuff that we've been talking about. You got to explain all the tax advantages. You got to explain all that you were talking about, beneficiaries and charities, and that takes a lot of effort. And a lot of people don't have the time, so they don't care. They just say, let's sell the easiest product to sell and get me my commission. You need a special kind of advisor to sell a more sophisticated product like a PPP.
So there's paperwork and it's time consuming. But I'm assuming when I set up a personal pension plan, a lot of the work is done by Integris, which is your organization, and the rest of the work is done by me. So how much time do you think a client really needs to set this up?
Not that much. It's more just understanding the concept. The initial couple of meetings where you're introduced to it and you look at how it fits in with the rest of the financial picture, because people don't live in isolation. They might have a holding company. They may have a family trust. They may have some real estate. They may have insurance. And so when we introduce the PPP, the question is, where does it fit in? And do I need to talk to my accountant? Because my accountant didn't know about the pension plan. And now I'm introduced something new. So all of that planning does take time. And so it's not a quick sale.
So the accountants have to be involved, lawyers have to be involved, the client has to be involved, but it's done in such a methodical way that I don't think my clients spend any more than, let's say, the first 2 meetings and the accountant's meeting all together. I don't see them investing more than an hour and a half of their time.
Yeah, I would say an hour and a half to about 3 hours, depending on how many extensive questions and how complicated is the family business.
And it also depends on how thorough you are with your paperwork, because a lot of the clients would like to read every page, and some of them will just say, okay, explain it to me and I'll sign. So it depends on the personality as well.
It does.
Right.
But it's to us, it's a very, very small investment of time for multiple benefits that pay for that 100 times over. So it's a trade-off, but you were asking me what's the downside. That's the downside. It's more complicated than an RSP. Therefore, you need to spend a bit more time understanding it.
What about fees and things that the cost? Are there any hidden costs to setting up a personal pension plan?
No, the fees are completely irrelevant, because by being able to access triple the tax assistance that you're currently getting from an RSP, you're generating tax savings that weren't there before. So CRA can't hold on to as much of your money. They have to give you a tax break or to refund you the taxes that you've prepaid. So it's that new money, that newfound money, that is used to pay our fee, and the rest is just gravy. So in real economic terms, the PPP auto-finances itself. And that's one of the best kept secret, because if people knew that, they would never ask about fees, because they would know that it's irrelevant what the fee is, since the tax savings cover the fee multiple times over. Let me give you a quick example.
Yes, please.
When you sign up for a PPP, not only are you allowed to do an annual contribution, so let's say that contribution is $25,000. Now let's use round numbers, $26,000. You're also allowed to do an RSP contribution, which could be another $26,000. So now we're at $52,000 in deductions. And if I'm paying tax at 50%, well, that's $26,000 refund that I'm getting from CRA on day one. That will pay for the annual fee for the next 8 years.
Wow.
Okay, that's just on day one.
Right.
Then you've got your buyback of past service, right? If you've worked for your company for a number of years and you've collected a salary, you can recognize the past service. And that creates a tax deduction for the company as well, which could be 100,000, 200,000. We've seen it go as high as $550,000. And that generates
That's a 550,000 one-time deduction as soon as you set up the plan.
As soon as you set up the plan, on top of the annual contributions we were talking about. Then, let's say you have $1 million in RRSPs at a bank or wherever, doesn't matter where it is, and they're charging you 1% on assets as a management fee. So there's $10,000 a year that is coming off the top of the RSP account, and you can't deduct it. If you roll your $1 million into the PPP, it now becomes pension money.
Right.
That $10,000 fee that continues to be applied because you have to manage the assets, let's say it's 1% or less. Now that $10,000 becomes a new corporate tax deduction for the business. So let's say your corporation is doing really well and you're taxed at 26.5%. Well, the $10,000 brand new deduction for the fees generates a tax savings of $2,650. Well, that covers our annual fee right there.
Right. So the advisor fees are basically tax deductible expense to the corporation.
Which you can't do with an RSP. It's not permitted. Right. So you see, and I'm not even done with you. There's other tax deductions that all, so all of these tax refunds and savings cover our fee multiple times over.
Mm-hmm.
So it doesn't matter. We could charge 5 times what we're charging and you'd still be better off than not doing it.
Is there any scenario, JP, that you find that you have said to the client you don't qualify? Who are the people that don't qualify?
Yeah. So if a company can't generate any surplus to save for retirement, after they pay their salaries and their suppliers and their landlord, and and there's nothing left to save, we say, why on earth would you set up a pension plan? You don't have you have a savings need, but you don't have the capacity to save.
That's right.
You're still in survival mode. So don't come to us, because all we're doing is create a drag on you. It makes no sense for you to come to us at this stage of your evolution. You have to come to us when you start making money and you're looking for a place to park that money so it doesn't get taxed.
So an ideal client is someone who is incorporated, someone who has retained earning. Is there a limit to that retained earning, JP? No? Okay. Someone who's constantly every year putting some money away in the corporation, leaving some money in the corporation.
Yeah, like the people that open up non-registered corporate investment accounts, mm-hmm. They're all candidates pretty much for a PPP. Okay. Because that means that they've got retained earnings that they're trying to park somewhere, and they're doing it in a taxable environment, in a highly taxed environment, right? Because if you open up a corporate non-registered investment account, it's not active business income. So when you earn interest, for example, that interest is not taxed at 12.2%. It's taxed punitively. And then after you pay the tax at the corporate level, when you declare a dividend to pay that into your own pocket as a shareholder, you have to pay tax again on your personal income tax. So it makes absolutely no sense, especially with the new more no measures, the tax on passive investments. Mm-hmm. As once you have $50,000 of passive income, your $500,000 small business allowance, where you're only taxed at 12.2% in Ontario, mm-hmm. gets chipped away. For every dollar, you lose $5 of that $500,000 allowance.
That's
so
right.
Not only are you punitively taxed, you're even taxing your operating company.
That's right. You're actually, the tax preferential treatment is not available anymore.
You lose it. So you're shooting yourself in the foot 3 different ways.
Yes.
By persisting in putting money in a corporate non-registered investment account, when you could dump it into a pension plan, mm-hmm. claim a tax deduction at the corporate level, have that money grow tax sheltered, pass it to your children with no deemed disposition if you have children in the business, and all the fees become tax deductible as well.
That's right.
And if you're going to sell the shares of the company because you'd like to get the lifetime capital gains exemption, by having taken the money off the balance sheet into the pension plan, it now allows you to qualify for the lifetime capital gains exemption. So you purified your business while claiming tax deduction, while growing your money tax deferred, and you protected yourself from the tax on passive investment rule. It's like you're killing 4 birds with 1 stone.
So many benefits, JP. Thank you for sharing those. Is there a preferred age that you would recommend? I mean, doctors and medical professionals, they start their life a little bit late. They start with, they are in the institutions for education on average 7 years longer than the rest of us, especially if they are becoming specialists. What age do you recommend that that they should start the pension plan for their?
Unlike an IPP, where you are penalized in terms of your annual contributions if you are under the age of 40, we don't have that restriction with the PPP, because our young physicians that join us, they use the defined contribution rules instead of the defined benefit rules. So they exceed the contributions that someone in an IPP is allowed to make. And they can also put money in their RRSP in the first year.
Wow.
So we don't have the age restriction. So you could have a 30-year-old, a 28-year-old physician signing up. Our youngest client is 15 years old. He's not a physician, of course.
As an employee of the company, I'm
works in
assuming.
a family business with his grandfather and his father.
Right.
So he's
And is that the legal age for someone to be employed and receive a pension?
I think it's province specific, but I think 14, 15.
Okay.
We don't have the age 18 restriction that RSPs have.
Yes.
You can start a little bit sooner with a PPP.
All right. So JP, thank you so much for so much information today. I know each hour that you consult is about $650 per hour consultation, and you have devoted this hour to this program. I really appreciate it. And I will leave your contact information in case somebody wants to reach out directly to you. And I may have you come in as come back to this program, because I do get a lot of follow-up questions, and anything that I am not able to answer, I would love to bring in an expert and have them answer. So I'll reach out to you again perhaps soon.
Well, thank you, Seema. I really enjoyed spending a little bit of time with you.